Hi, very good morning to everyone. My name is Anuj. Over the next half an hour, the plan is to take you through some tax aspects as well as structuring aspects in relation to the setup of a Singapore family office. As we all know, Singapore has been on the forefront of uh, helping families set up their businesses, and with that, they also encourage set up of family offices in the recent years. Uh, so Singapore, over the last few years, has now touched more than 400 single family offices in Singapore, and that's a big number and a big achievement in a relatively short period of time. So I'm just going to start with sharing the agenda for today. So I'll do a brief introduction of what a single family office in Singapore is about and what we mean by single family offices. And then we'll also touch upon the Singapore tax incentives that are available to single family offices. And we discuss some common structures. We also discuss the concept of a variable capital company, which is a new legal entity form that's been made available to uh, investment funds in Singapore. And then we wrap up and we have time for questions at a later stage. So, in terms of the family office meaning, before we go that, we should probably touch upon what families do today. Now, if you ask a lot of families, this slide basically demonstrates how they make investments. Usually, the patriarch or matriarch will just hold the assets either in their name, or if they think that carrying it in their name carries certain risks and they do not want that, what they will do is they will set up a company in an offshore jurisdiction, maybe BVI, maybe Cayman Islands, maybe Guernsey, and hold the assets. But this structure has significant flaws actually. Uh, if you just set up a company in an offshore jurisdiction without having adequate substance there, then it is possible that the foreign company may attract tax in your home jurisdiction, despite you feeling that the company has been set up offshore and you should not be liable to your home country taxes. Just the incorporation of companies overseas does not solve any problem. So let's look at here what are the key tax considerations you should keep in mind when you set up structures. Okay? And we'll start right from the top and then go down to the bottom. So in this structure, we have set up a family trust in an offshore jurisdiction, which is then holding a BVI fund company. The BVI fund company, or you can call it an investment holding company, will then hold the investments, and the investments are managed by a team of professionals sitting in some other jurisdiction. Now, if you look at the tax issues, those are the boxes in orange. First and foremost, you need to worry about tax in your home jurisdiction where the beneficiaries are located. Then you also need to think about the tax and investment structure location. So in this case, I'll assume that the structure is set up in the BVI. So you need to think about whether BVI has any taxes that may be imposed on you. BVI may not have taxes in this example, but if it were in some other jurisdiction, you would have to consider that. Then you need to consider the tax implications in the country where the BVI company is actually being managed from or being run from. As I mentioned earlier, by just incorporating a company, you do not mean you cannot take the tax issues away from you. If, in this example, if the investment professionals managing the BVI company are based in Hong Kong, Singapore, China, India, then you also need to consider the BVI company's tax implications in Hong Kong, China, Singapore, and India. And finally, of course, if the BVI company is making investments in several jurisdictions, you need to think about the tax in those jurisdictions. Okay? So in summary, we are looking at least four jurisdictions you need to worry about tax. First, tax in your home jurisdiction where the beneficiaries are, tax in the location of the structure, tax where the investment decisions are made, because that may be different from the location of the beneficiary. And finally, tax in the country you're making the investments. Now, uh, let's move to what is the meaning of single family office. Okay. Now, there are many people having understood a single family office to mean different things. Uh, for Singapore, generally, we would take a single family office to basically mean an entity which manages assets of one family. Okay. Now, you could do other things within that entity, for example, philanthropy or administrative tasks, but uh, we try to hinge it on the entity having the right investment people to be able to manage assets of a particular family. Yeah. And if you're managing the assets of a single family, then we'll call it a single family office. And if you're managing the assets of multiple families, then you'll be called a multiple family office. Now, within Singapore, it is not the regulator's intention to regulate single family offices. Multi-family offices, yes, they will be regulated. You need to have a license. But for single family offices, the expectation is that you do not need to get licensed. So you can actually work under a particular exemption from license. Having said that, there are some procedures and processes to be followed in order to reach the end result of a confirmation that you are exempted from holding a license because you're managing your own money. So let's look at two scenarios. Yeah? In this structure, we have a fund on the left side, which is your investment holding company, which makes investments. And then you have the fund management company. This is actually your single family office on the right side. And there's a common holding company. So under the Singapore Securities and Futures Act, where the fund management company, which is your single family office, is managing the assets of the fund, which is your investment holding company, because both these entities are owned by a common holding company, the fund and the fund management company are considered related parties. And because the common holding company is held by a single family, in my example, you can actually get a legal opinion to confirm that the fund management company, in this case, does not need a license and can operate under an exemption available to manage related party money. Okay? So in this example, once you get the related party exemption confirmed by your lawyers, you can actually start managing the fund's money. Okay? Now, if you look at this next example, we have a discretionary trust which is held by, which is holding a fund, an investment holding company, and then we have a fund management company which is held by family members. Now, although the family members holding the FMC are the same as the beneficiaries of the discretionary trust, in this example, you need to apply to the MAS for a case-by-case exemption from licensing for the fund management company. Okay? The reason being the current legislation says that in order for the FMC to be exempted from holding a license, the FMC should either hold the fund or be held by the fund or should have a common holding company. And because in this structure, if you notice, there is no common holding company. Yeah. The previous structure, if you see here, has a common holding company, which allows you to squarely fit under the exemption from licensing, and you can get a regulatory opinion on this and then commence your work. But under this, it does not squarely fit under the regulatory exemption, but the MAS understands that this is still managing a single family's money, and therefore, if you write into them explaining that the beneficiaries are members of the same family, then the MAS should give you a case-by-case exemption, after which you can commence your work as a single family office and manage money of the fund. Let's go to the Singapore tax incentive. So what we so far discussed was the regulatory exemption from licensing. Now what we will be discussing are the tax exemptions and the tax incentives available. So there are always two things you should keep in mind. The first thing is regulatory exemption from licensing, and then the tax exemption. Okay? So now let's discuss some of the tax incentives that we have in Singapore. Okay? So uh, if you remember, I just mentioned earlier that if you have a BVI company which is managed by individuals in another country, then you need to consider taxes not just in BVI, which we know does not have taxes, but also in the country where you're managing the BVI company. So Singapore tries to address that situation. Now, what the Singapore tax incentives do is that they say that if you have a single family office or a fund management company in Singapore, and you're managing a fund or an investment holding company, which is either set up outside Singapore or inside Singapore, if you meet certain conditions, your fund will be exempt from Singapore tax. So in this structure, you can see on the left side, if the fund gets the tax incentive, then it derives exempt income, and then it pays out dividends to the family members free from withholding tax. So what are these tax incentives? So there are two very popular tax incentives. They are Section 13R and 13X. Now the tax incentives have recently been renumbered, and therefore 13R has now become 13O, and 13X has become 13U. Okay? So if you look at 13O, you need to apply to the government for this tax incentive to apply to the fund company. The legal form and location has to be a Singapore company or a Singapore VCC. Under 13O, the fund has no fund size requirement. So the fund can actually be a $10 million company, $50 million company, or $500 million company. There is no minimum fund size requirement. The fund has to meet at least 200,000 annual business spending. Okay? Now the fund typically pays fund management fees to the fund management company, and therefore the annual business spending condition is generally met through the fund management fee payment. The 13O fund needs to be managed by a qualifying fund manager. This means that the fund management company which is managing the 13O fund should either be licensed or exempted from holding a license. In your case, because you're a single family office, you will probably be exempted from holding a license, and therefore this condition should be met. Under 13O, there are some shareholding tests. So what they do is that the 13O fund is actually tested for shareholding, where the shareholders are split between good shareholders and bad shareholders. Now, there are many categories of good shareholders and there are some for bad shareholders. But what you should take note is that any individual holding shares in a 13O company is considered a good shareholder. So generally, for family offices, you should be able to satisfy the 13O shareholding test. And just out of interest, there are other thresholds as well. For example, 13O also says that if anybody owns less than 30%, then you are a good shareholder. So even if you were not an individual, but you were a corporate and you held 30%, then you would be a good shareholder. But if you held 31% or 60%, then you would be a bad shareholder. There are other requirements like Singapore-based fund administrator, and you cannot change the investment objective of the 13O fund once it's approved. Okay. So that's on the left side of the screen. If you look at the right side of the screen, that is the 13X, or what we call now 13U tax incentive. So just like 13O, 13U also requires an approval, but the legal form and location can be anything and anywhere. So there is no restriction, unlike 13O. 13U does have a fund size requirement, so there's a 50 million minimum fund size requirement at the point of application. There is also a need for a 200,000 annual local business spend under the 13U scheme. There, under 13U, you also have the fund manager who should be either licensed or exempted from holding a license, just like the 13O scheme. Except that under 13U, there is an added criteria that the fund management company should have at least 3 investment professionals. In terms of ownership restrictions, 13U has no ownership restrictions. So what it does is it replaces the ownership restriction with a $50 million fund size requirement and a 3 investment professional requirement of the fund management company. Now, 13O and 13U scheme both are providing the same exemption. Okay, but what you need to note is that the 13O and 13U scheme does not exempt everything. They only exempt a very finite list of items, what we call specified income from designated investments. So some of the things that are not on the exemption list are Singapore real estate, cryptocurrencies, and some of the things that are on the list are shares in companies which do not hold Singapore real estate, or securities issued by companies which do not hold Singapore real estate, and so on. Foreign real estate is also on the list, which means you can hold foreign real estate under the scheme and be exempt in Singapore if any tax were to be paid in Singapore on that. So let's get to some specifics of the 13O schemes using a diagram. So you need an application. It's mentioned on the top. The fund needs to be a Singapore company or VCC. It needs to be Singapore tax resident. Use Singapore-based administrator, 200,000 annual business spend, invest within an approved investment objective, and there is a qualifying relevant owner test, okay? Which is a good shareholder and the bad shareholder test. Now, this is giving a little bit more detail on who is a good shareholder. So as I mentioned, a good shareholder is an individual, and there are some other categories. Who is a bad shareholder? Anybody who is not a good shareholder becomes a bad shareholder. One example of a bad shareholder is, say, a Singapore company which owns 60%, in my example, of the 13O company. Okay, now let's just test ourselves. And I know we are all on the virtual and not in a room together, but let's look at this diagram and try to identify the non-qualifying relevant owners or the bad shareholders. Let's start with the screen on the left. I'll just give 10 seconds or 15 seconds for people to think through. On the screen on the left, if I ask you who is a non-qualifying relevant owner under 13O scheme, your answer should be the Singapore company which owns more than 30% in the Singapore 13O fund. Okay? In this example, it owns 70%, so that is a bad shareholder. And what happens to a bad shareholder? They are basically paying a quasi-tax. So 17% times, which is the Singapore corporate tax rate, times the fund's profits for that year, times 70%, which is the Singapore company's share in the fund, will be payable as a penalty by the Singapore company. The Singapore individual will not pay any penalty because it is a good shareholder. Let's look at the screen on the right. Again, I'll just give you 10 seconds to think who is a good shareholder and who is a bad shareholder. Okay, so in this example on the right side, both are good shareholders because you mentioned that Singapore individuals, whether they hold 30%, 50%, 90%, they're all considered good shareholders. While the Singapore company in this case owns less than 30%, that's why they are called a good shareholder. So what are the common questions we hear on the 13O scheme? One common question we get is that can the fund management company or the single family office have only one employee? So the answer to that is yes. Okay, there is no prescribed number, and you cannot have 0, but you do not need to have 3. You need the right number to manage the investments, and if you feel one employee is the right number, then you need a full-time Singapore-based employee in the fund management company. and it can be only one. Can the employee be a family member? Yes, the answer is you can have a family member who can become the employee. He or she has to be qualified. It doesn't mean that they have to pass exams, but they should be able to devote time as well as skillfully manage the investments. And they cannot be just putting a name forward to show that you're managing, but you're actually not doing anything. Does the employee need investment experience or qualification? We do have to submit the CVs of the investment professionals when we do the 13O or 13U application. Uh, but if the concern is, do they have to be working with an investment bank in the past or have an MBA? There is no such strict criteria. Yes, that would help demonstrate that they are qualified investment professionals, but it can be a family member. And if he or she is qualified or believes he or she is qualified, then it should still be okay. You do have to submit a fit and proper declaration when you submit the 13R and 13X applications. Uh, but in terms of specific investment experience or qualification, there is no prescribed criteria. Can the 13O company be held under a trust? The answer is yes, it can be. As long as the beneficiaries are all individuals, you should be okay. How long does it get? How long does it take to get approved under 13O scheme? So generally, for all such applications, you should be buffering about 6 months to 9 months. Yeah. Let's look at the 13X or the 13U scheme and some specifics around it. Okay. I'll just give you 10 seconds to digest the structure. So as I mentioned, I'm starting from the top. Application is required. There's no restriction on legal form, so the fund can be offshore or onshore. The FMC needs 3 investment professionals. The fund has to have 50 million fund size, spend at least 200,000 locally annually, needs to invest within the approved investment objective. Now, what I haven't covered in this slide deck in much detail is basically that the 13X structure, 13U structure can also accommodate some more complex structures like master feeder SPV, and master SPV structures. So there are some sophisticated families who may use 13X, even if they find that 13R is also working for them. So let's look at this. What is the threshold for non-qualifying relevant owners in this scenario? Now, just a reminder that 13X or 13U scheme does not have a qualifying and non-qualifying relevant owner. So there is no threshold for qualifying or non-qualifying investors. Okay, but the threshold is replaced with a minimum fund size, which should be 50 million, not 500 million, not 200,000, but 50 million. Some common questions that we get posed for 13U structures. Can the 3 investment professionals work for more than one company? Okay. The answer is no. You have to have 3 full-time Singapore-based employees in the single family office or the fund management company so that they can qualify as the 3 professionals we need for 13U purposes. Are there any salary requirements for the investment professionals? The answer is yes. A minimum base salary of 3,500 Singapore dollars. And just a reminder that just because you pay somebody that much, it does not make them an investment professional automatically. Their role, their responsibilities, qualifications will determine whether they are investment professionals, and then we apply the minimum salary threshold. Can the 3 investment professionals be based overseas? So the answer is no. They have to be Singapore-based employees. Of course, you can travel and do back and forth if you wish. This one's sometimes quite, I would say, hilarious actually. Which scheme is better, 13O or 13U? So there's no right or wrong answer. There are some clients who prefer 13O, some who prefer 13U, some who actually switch from 13O to 13U eventually. Yeah. But recently we are seeing more and more 13O applications because there's no fund size requirement, there's no minimum headcount requirement, so it's relatively easier to start the family office, and therefore 13O we tend to see more nowadays than 13U. So let's look at some common structures. Uh, this structure, very common, where you have family members setting up a simple structure. You have a fund and you have a fund management company. Both are held 100% by the family. Okay? And remember, for the family office, on the right side, you need to get the regulatory exemption from licensing, and the fund has to get a tax exemption, 13O or 13B. So I'll just wait for 5 or 10 seconds so you can process the structure. Okay, this is another common structure where we have family members set up a common holding company, and the common holding company will own the fund as well as the fund management company. Usually when we see this structure, the clients are looking at the 13X or a 13U structure and not 13R or 13O. Okay, next. This is common where you have a trust. So there's a trust and there's a fund held by the trust. And then you have a single family office, which is held by the family members directly and not within the trust. Okay? Now, there could be more holding companies in between the family trust and the fund, but we're trying to simplify the structure for you, and therefore we're just putting a base trust structure for you. Okay? Now, one of the reasons why the family office is not held by the family trust is it's possible that some of your trustees may not want an operating company within the trust, and therefore they only will hold the fund, and that too perhaps with an intermediary holding company in between the trust and the fund. And I'll just give you a few seconds to digest the structure. Okay, so that gets us to the next topic of variable capital company. Okay, now this is a new legal entity form. It's just been around for the last couple of years, but it's been a very big success. So before I go into the slides, I should just highlight that single family offices cannot use a VCC today. Okay? That's just how the rule is. If a VCC has to be set up, it has to be set up by a licensed fund management company. And right at the beginning of the presentation, I already mentioned to you that single family offices operate under an exemption from licensing. So they're not licensed. And therefore, today they cannot use the VCC. Why are we covering it? Because there is a big demand for VCCs by many families, and the authorities are looking into this, whether VCCs should be allowed to be set up by single family offices. So we don't know when that will happen, but it's all under discussion. So what are the key characteristics of a VCC? I'll start from the left corner, top. So basically, this is a legal entity form, and that can be used for any investment strategy, be it traditional or alternative, can be open-ended or closed-ended. The VCC is such a legal entity form that you can actually relatively simply re-domicile a foreign company to a Singapore VCC. Okay? So not for families, but for hedge fund managers and other managers, that has actually been done, where they re-domicile their Cayman or Mauritius funds as a Singapore VCC. The third item at the bottom left. Now, VCCs require a Singapore-based licensed or a regulated fund manager. There is mention of unless exempted under the regulations. That's referring to banks or other financial institutions who have a bigger license, and therefore they have some sort of exemption for the fund management piece. It is not referring to families and their exemption. So as I mentioned, you cannot use a VCC today because of this restriction, which says that a VCC has to be set up by a licensed manager. The VCC can be a standalone entity or can be set up as an umbrella entity with multiple sub-funds. Now, this is a very important part of the VCC. So VCC is a legal entity form, so it's a company. And unlike a company, the VCC can have many compartments. And each compartment we call a sub-fund. The assets and liabilities of one sub-fund cannot be mixed with another sub-fund. So there is legal protection in Singapore for it. So this feature gives it tremendous value, and I will explain some uses of a VCC for you in the subsequent slides. Then VCCs can adopt Singapore Financial Reporting Standards or the International Financial Reporting Standards or US GAAP as well. If you set up a company, then you have to follow Singapore FRS. And just like private companies in Singapore, VCCs can also apply for a 13O or 13U tax incentive. So what are the things you will need for a VCC? So of course you need a Singapore registered office. You need a company secretary which is resident in Singapore. You need an auditor, which has to be a Singapore auditor. You need a fund manager who's licensed, and you need one director who must be a Singapore resident, and you need a Singapore-based administrator under the 13X and 13R schemes. What is the success rate of the VCCs? So if you look at the take-up, it's been quite significant. In the pilot program, which was day one, basically, we launched 20 VCCs. This was back in January 2020. And in the first year itself, we had more than 200 VCCs, and now the count is more than 500 VCCs. Yeah? So it's been a significant success. So let's look at some uses of VCCs. I'll just let you take a look at the structure shown over here. So if you have a master feeder structure, a VCC can be used as a feeder in my example, or it could have been used as a master. I already explained that a VCC is actually a good tool if you want to redomicile something overseas to Singapore. There are rules to be followed, but the redomiciliation into a VCC is slightly easier than redomiciliation into Singapore as a private company. Managed accounts. So let's say a wealth manager has 4 clients. The wealth manager or the private bank can actually set up a VCC with 4 sub-funds and get each client to invest in one of the sub-funds, which the wealth manager, who's a licensed person, can manage. I'll just let people digest the structure. Then you can use it as a pooling vehicle. So here, let's say that there's an individual who wants to use bonds to make investments in bonds. There's another individual who wants to invest in real estate and bonds, and so on and so forth. And then we have a wealth manager who has all these strategies, and he sets up a VCC with 4 sub-funds. Okay. Now, what we have here is the individual 1 will invest in the sub-fund 1. Individual 2 will invest in the real estate and the bond sub-funds, and so on. So you created 4 sub-funds based on strategy, and then you got investors to choose the sub-fund they want to invest in. This is also quite commonly used, where there's a family who wants to use a VCC and they want a private bank or an external asset manager to manage the VCC. So the VCC is set up and there's a trust which holds the VCC, but the fund management is done by the EAM or the private bank. So that gets me to the last slide before I take questions, of course. So in summary, what we communicate to clients is that Singapore does offer opportunities for wealth planning and mitigating your tax risks. But one thing to note is that Singapore requires substance. So if you intend to set up a structure with no people here and no substance, then Singapore does not work. Okay, and that is an important point to convey because we do experience clients finding some of the conditions a bit hard to meet. And if it is hard to meet, then perhaps you should wait for the right time to create a Singapore structure until you can satisfy all the conditions. For example, do you have the need for investment professionals? Sometimes you might hire somebody, but he or she may not have enough things to do, you might feel. So only if you have the right fund size, then you would set up your family office with the right people. Okay? And the final point, which is true for so many other things, is that pay attention to the details, because uh, we have seen cases in the market where things may not have been paid attention to, and after a couple of years, it comes to attention, and that may cause some issues in due course. But in summary, Singapore does offer great opportunities. If you can get the substance here, then it's a very balanced location to have your single family office as well your investment structures. So with that, I'll just see if anybody has questions or comments. So there's a question over here. Uh, how do you compare the tax environment of SFOs in Singapore and Hong Kong? Okay. So obviously a very uh, common question that we get posed. So, uh, so Singapore and Hong Kong both have their advantages. I think the first uh, item that people should consider is, where do they have more substance or activities or presence, and then consider where they should set up the family office. So, for example, if your investments are mostly in North Asia and your family ties and your businesses as well as your professionals are all based in Hong Kong or North Asia, then you might actually choose Hong Kong. Uh, while if you have things uh, more than just North Asia, and you do have some talented people in Singapore you want to hire and work with, you could set up a single family office in Singapore. Uh, so I think both the places have their merits. And the first criteria we always ask clients is, where do you naturally see, leaving aside what the government has to offer, uh, uh, what do you think should be the location of the family office? Yeah. Uh, the second question is, will this presentation be made available as a handout? The answer is yes. We will give an abbreviated version of this presentation to the attendees. All right, so there's no more, or there's one more. Will MAS allow family offices to manage VCC? So currently it is not allowed, and there is a strong appeal to the MAS that family offices should be allowed to manage VCCs. And when I say family offices, here I mean single family offices, because multifamily offices can already manage a VCC because multifamily offices are licensed. Yeah? So uh, we don't know what the outcome will be, but the hope is that the MAS in time to come will allow single family offices to manage VCCs. I'll just give a few more minutes for questions. Okay, there's one more. Uh, since single family offices cannot use VCC structure, what type of vehicle is used for the investment company and fund management company? So that's a good question. So most of the cases, uh, actually I cannot recall any variation to this. The single family office will always be a company, and the investment company will most likely be a Singapore company as well. Okay. Now, uh, you could use a foreign company for the investment company, and we do see that as well. But often we see the use of Singapore companies as your investment company. But the long and short of it is we do see companies, be it Singapore or offshore, for the investment company. Yeah. You may have added layers of an investment trust on top. You may have intermediary entities. In fact, you may even have a foundation. So we do have European clients who may have some foundations at the top, and then the foundations would invest in the Singapore structure. And we have also actually made some requests to the authorities to consider creating or allowing a legal entity form of a foundation in Singapore, because we are seeing that demand also slowly materialize. Uh, any changes to the 13O scheme is the next question. So, uh, in the budget that was announced on 18th of February, just a few days back, there was no material change to the 13O or the 13U scheme. They just expanded the list of qualifying exempt investments, what we call designated investments. They expanded it to include physical precious metals. Okay, there are some limits prescribed, but it was a good enhancement to include physical precious metals as well. All right. So I think I will end my presentation here. Thank you for your attention and time, and I will send the slides across. So if there's anything more that you wish to discuss, please you can reach out to me. Thank you so much. Bye bye.